Did you know that your bank is obligated to report on your activities to the federal government? The Bank Secrecy Act requires financial institutions to assist U.S. government agencies in detecting and preventing money laundering and other crimes. These obligations apply not just to banks, but also currency exchanges, money transmission businesses, broker-dealers, casinos, pawnbrokers, travel agencies, car dealerships, and more. They meet this obligation in a number of ways. First, financial institutions verify customers' identities and keep records of their transactions that could be useful in criminal, tax, or other regulatory investigations or proceedings. Second, they have to report certain transactions to the federal government. For example, a currency transaction report must be filed for any deposit, withdrawal, exchange, or other payment or transfer involving currency of more than $10,000. It's also illegal to try to avoid that report by breaking a transaction into smaller increments. Financial institutions also file suspicious transaction reports if they suspect a possible violation of law or regulation. SARs are required to be kept confidential, including from the customer who is the subject of the report. In 2019, more than 20 million reports were filed by more than 97,000 financial institutions. These reports are meant to be used by law enforcement to fight money laundering, other financial crimes, and terrorism. These rules could impose heavy costs on financial institutions and individuals alike. Between the mandatory compliance programs and the potential liability for failing to have a good program or file required reports, some financial institutions choose to simply reject customers or activities that make compliance more difficult. Some individuals cite the privacy intrusions as reasons to not have a bank account. Proponents of the Bank Secrecy Act initially justified the law as a way to prevent Americans from using foreign bank accounts to evade U.S. laws. But over time, the focus has expanded to include fighting terrorism and other criminal enterprises. Opponents, on the other hand, say that there is virtually no evidence that the Bank Secrecy Act's surveillance systematically reduces illicit activity, noting that very few of the reports are followed up on. Opponents say that even if the law had some deterrent effect, the invasion of individuals' financial privacy is inappropriate. The Supreme Court upheld the constitutionality of the Bank Secrecy Act in the 1970s, but back then, the law required much less from financial institutions. Several Supreme Court justices, including Justice Thurgood Marshall, objected to the law's intrusion into individuals' privacy under the Fourth Amendment's protection against unreasonable searches and seizures. Since then, the scope of surveillance has greatly expanded, both because of additional regulatory requirements and because of the increasing use of intermediaries in routine financial transactions. Preventing and detecting illegal activity and protecting financial privacy are both important goals. How should a regulatory regime balance those competing interests? How can the effectiveness of the regulatory regime be judged? And how can the government ensure that the information gathered is not abused?